Okay, good morning, ladies and gentlemen. We will have in-depth presentations on many of the topics in this session. So I'll give you just a general overview of the recent trends in the steel industry. So let me start with the macro picture. Global GDP growth is still positive, but clearly weaker than expected a few months ago. Compared with the January, the April 2026 IMF update cut global growth for 2026 from 3.3 to 3.1%. And even that is assuming that the military conflict in the Middle East would finish in May. For that, I would like to remind everyone that in 1967, Egypt closed the Suez Canal for 8 years. Let's hope that history does not repeat itself. For steel, that means we still have an underlying base of demand because the world economy is growing. But the recovery is not sufficiently strong to generate a proper rebound in steel consumption. That distinction is important because it explains why demand is holding up better than expected, while the market still feels oversupplied and highly competitive. Next slide is GDP regional growth projections. If we break the global picture down by region, the message is actually not bad. Growth is not evenly distributed, but the important point is that the strongest momentum is coming as before from India and emerging Asia, regions that continue to expand at a healthy pace and remain supportive for steel demand. At the same time, some of the more mature economies remain soft, so the global recovery is not perfectly balanced. But it's still broad enough to create opportunities across different markets. The good news for us is that the World Steel Association predicts that the world steel demand is beginning to recover in 2026. But again, that recovery is really uneven. Total global steel demand will increase 0.3% in 2026, while China will go down 1.5%, Africa will increase by 3.8%, European Union, and United Kingdom will increase 1.3%, and India is a standout at 7.4%. So this is not a strong cyclical rebound, it's more like a mild improvement from a low base for us, but it's still good. Moving on to construction sectors. In Europe, European construction is proving more resilient than expected. Residentials remains very weak, but infrastructure and public spending continue to provide support. As we discussed at the previous conference, the real possible upside in Europe is housing. The European Commission now estimates that Europe needs to build around 2 million homes per year to meet the current demand. Let's see if the governments would be able to unlock this huge demand in Europe. In the United States, the picture is very, very similar to Europe. Residential remains very soft. Support comes mainly from selected infrastructure, power, and data center projects, rather than from the broad-based construction activity. China. Demand in China remains one of the key problems for our market. And the important point here is that there is still no real estate recovery there. In the first quarter of 2026, residential floor space sold was down 13.1% year-on-year, and commercial floor space was down 10.4%. Sales volumes remain very weak, and that means domestic demand still not strong enough to absorb all the steel production. In India, India remains the strongest demand story. Infrastructure spending continues to support growth. India raised planned infrastructure spending for 2026-2027 by 11.4%. It's one of our large markets where genuine in expansion in steel demand is very, very visible. Okay, going towards the production. World steel production. Global crude steel production in 2025 reached around 1.85 billion tons, which means the industry is operating under the peak level of 2023-2024, back at the level of 2018-2019. If we look country by country, the first quarter of 2026, geography of production keeps shifting. Some regions are stagnating, some are declining, while others continue expanding capacity or maintaining high output. India remains the clear leader, with the steel production up 10.8% in the first quarter 2026. Germany recovered around 9% production from very low base. US grew 5.7% and Turkey 5.3%. Congratulations. Meanwhile, China was down 4.6%, Brazil was down 3.1%, and Russia down 10%. Also a very important development that Iran is out of the 10 biggest steel producers, and Vietnam is in, first time in history. Next is our favorite topic, Chinese steel exports. As expected, we have a new record. China exported more than 119 million tons in 2025. In the first quarter of 2026, exports were down 9.9%, mainly due to the implementation of the export licenses. But these exports are still historically very high. We should generally in 2026 expect lower numbers than 119 million tons, but we should bear in mind that things may change very quickly in China. You know how dynamic Chinese mills are. And we should really watch out for what's going on there. In the first quarter of 2026, for example, Chinese car sales have been reportedly down 22%. So that means 1 million car fewer sold in 2026 than in 2025. That means, less steel consumed, and it means more steel needs to be exported. So we should be very careful with that. Okay, moving on to the global long products consumption. In the first quarter of 2026, global long product consumption declined only 0.5%. That means stable demand, but no actual improvement. That's why markets remain so competitive. If we looked at the long products by different products, there is no major change. It shows minor adjustments, and the overall market remains very flat. So some better mix of the product might help an individual mill. Overall, it doesn't really affect the volume problem. If we look at the rebar consumption by regions, it's all pretty much stable. Europe is flat at 31 million tons. North Africa improved from 11 to 12 million tons. Other world countries is going to improve from 49 to 51 million tons. In Asia, the biggest market with 268 million tons is China, and it's down, but the rest of Asia is growing. The weakness is concentrated mainly in China, while most other regions are stable or better. Talking about the prices, basically, the reinforcing bar, wire rod billet prices. As noticed in the last conference, the finished steel prices remain remarkably stable. Unfortunately, this stability should not be mistaken for strength. It reflects mills' very weak pricing power. Input costs, scrap, freight, energy were very volatile. And yet mills could not pass these costs, these increases to the customers. The spread, reinforcing spread, on paper, the spreads may look acceptable. In reality, it remains way too thin for comfort in this volatile cost environment. As I said, input costs move faster than finished steel prices, and mills are not able to pass this in full. What looks stable on the chart often means very challenging environment for the steel mills. So what are the strategic trends in the steel market for us, for going forward? I wanted to have a look and try to identify the main, what will happen to us going forward. and identified maybe 3 things which I think are very important. What the market is starting to price now is not just steel, but certainty of getting steel where and when it's needed. In the short term, disruption due to the conflict in the Middle East affected freight, insurance, energy, delivery times. We have been discussing it for some time at our conferences. The choke points, volatility, execution risk. Now the market is starting to price it in real time. This may change, and it has changed already, the buyer's behavior. When buyers have little buffer stock and execution becomes less predictable, buyers become less willing to optimize only for the price. They want to be sure that the steel will be delivered to them. The cheapest offer on the paper may no longer automatically be the most competitive offer in the market. Another very important point, I think, is the market access. And I believe that the market access is now the key to competitiveness in steel. And this is one of the biggest changes in the market. For many years, the market mostly compared mills by cost of production. And that is no longer enough. A mill may have cheap power, cheap labor, and raw materials. But if it tries to sell into the market with quota, import, carbon tax, certification requirements, then the theoretical cost advantage suddenly becomes less relevant. In this environment, market access becomes a key part of competitiveness. By market access, I mean something broader than logistics. It includes physical access, ability to deliver competitively and reliably. It includes documentary in regulatory access, paperwork, certificates, custom clearance, quota compliance, and increasingly it includes carbon tax compliance. Market access is becoming as important as cost. And that leads us to another very important trend, which I believe will define the steel market for the next few years. I would like to step away a little bit from today's market and talk about the strategic direction. For many years, the global economy rewarded efficiency above everything else. The logic was simple. Buy the cheapest ton, keep supply chains lean, and don't worry too much where the steel came from. Conflict and what will happen after the conflict will change that logic. Governments now begin to think more seriously about security, defense, energy independence. They stop behaving like pure cost optimizers. They start thinking in terms of national security and national capacity. That changes completely the steel equation. If a country wants stronger defense capability, it needs factories, logistics, ports, rail, storage, shipbuilding, and industrial depths. All of that is steel intensive. If a country wants energy independence, it needs not only fuel, but also power generation, transmission, grid, substations, storage, interconnections, and backup capacity. All of that, again, is very steel intensive. If a country wants social stability, housing becomes part of the same story. In many developed economies, housing shortages are no longer just a real estate issue. They become political economic constraint, and solving it will also require steel. So the point is, not the world suddenly needs more steel everywhere. The point is that governments will place more value on domestic steel capacity tied to strategic sectors. In other words, steel becomes less of a purely global commodity and more of a local strategic material. That's why I think as a result, the global steel market may remain oversupplied, and at the same time, strategically important domestic production will begin to command a premium. That's, in my view, is the most important medium-term shift for our industry. Thank you for your attention.
From the floor for Mr. Gordienko. May I ask a question, Alex, before we let you go? Obviously, the European steel market has been going through significant change since the beginning of this year. How important is the impact of CBAM on the European steel market, from your opinion?
So CBAM, originally we all thought that CBAM will be defining moment in the steel market. After having lived with it for 4 months now, we believe it's a little bit different. So basically it gave the bottom to the market. In the past, the wild trends of prices swings up and down created a lot of instability. Now with the CBAM, the market, the price, let's say, changes, they are not as wide as they used to be. That's, I think, the most important real life effect of the CBAM on the European market.
Thank you. Rami, can we have the microphone?
Thank you very much, Alex, for your presentation, the great one as usual. On the demand side, don't you see any future, prospects or let's say some, efforts by the EU and the EC Commission to tackle really the real challenge for EU? Your demand was 152 million tons in 2019, and you guys lost more than 20 million tons in just like 5-6 years. Is there something to be done on the demand side, apart from the things that are being done very actively on the trade barriers, like the quota reduction and like the CBAM, etc.? Because the demand, is, in my opinion, is the main challenge.
So it's a very good question, and it's a very important question. And it's a right way of looking at the steel market. So there is a short-term and the medium-term effect. For the short term, not much can be done. For the medium term, I believe that things are changing in Europe, and they're changing from 3 directions. First, Europe started building defense capability, which didn't exist even 2 years ago. That means a lot of new factories, all types of infrastructure, and we see it in day-to-day projects. This is what basically keeping the market going for the time being. Next, Europe needs to build new energy infrastructure, new energy generation. So we see, for example, about nuclear power plants, about all types of grid build-up. All of that will create demand, but it's not a short-term demand, it's more like a medium-term demand. And as I said, the housing issue became such a huge problem, and it's hard for people outside of Europe to believe that you cannot build. There are restrictions everywhere. You cannot build housing, and people just don't even bother anymore. And we have a shortage of 2 million, it's official European Union story, European Commission, 2 million houses need to be built in Europe just to keep up with the current demand. So it's all there. Whether it will be done or not, hopefully it will be done.
Thank you very much. Any other questions?